Let's get to it, guys. If you want excitement, you should get a dog because for close to 10 years, multifamily was sold as this exciting kind of investment, like magic elixir. And we all know how that story has ended. And this is not another autopsy like some of our earlier webinars. This is the playbook. Today, we give you the playbook because the best multifamily deals in America are not happening over email, they're happening over a phone directly with the lender, say on a Tuesday afternoon when most people have checked out. And nobody else is going to show you on a webinar, but we are going to do that.
Okay. So why aren't these deals, Omar, on the open market? If they're that good, why don't we dive into why every operator isn't doing them?
Well, first of all, the obvious answer is nobody likes to air their dirty laundry in public. So that's the obvious answer. But the other thing is these don't trade on the open market because the entire capital stack, the way the loan agreements work, everything has to be created from scratch. Think about completion guarantees, prepayment penalties, what are the rates and spreads going to be, what are the financial covenants going to be, what are the closing timelines going to be. All of these things need to be negotiated in a compressed timeline expeditiously. And this has to be a conversation between sophisticated counterparties because if these conversations are not between sophisticated counterparties and counterparties are, say, a new borrower operator and a lender, if either one of these parties, and by the way, sometimes it is the lenders that are not that sophisticated, right? Then these talks will never go anywhere. They have to be private, they have to be confidential, because most importantly, we're in uncharted territory from a historical point of view, in the sense that for a couple of generations of borrowers, sponsors, and lenders, and I include lenders in this, they just haven't faced these situations before. They haven't gone through these types of cycles before. So that's why these deals are not in the open market all the time.
Right. And which again is why most operators, they see the headline, not the deal, and the deal happens before the headline, and that's what we want to get into. So it's taken us 5 boardwalk webinars to build to this one. If you watched all of them, that's wonderful. Thank you. This is the synthesis. If you haven't, we have those prior episodes on YouTube.
Cool. So one number now I'm going to tell you is going to change everything. But you have to realize this hope that the entire industry, everyone had, that rates were going to go down and things were magically going to improve, that has all gone away. We are in a higher for longer rate regime. Even the new incoming Fed chair has made that clear as of yesterday. But the one number that has changed everything, everybody was having these, these platitudes about survive till 25 and all of this stuff. That is that in most of the country, we either had 0% rent growth or negative rent growth in most of the country. And this is for all of 2025. And this is for a year where everybody said, you just got to survive till this year. Things are going to be fine. Now, this type of rent growth, it's been the weakest since 2008, since a great financial crisis. And the issue is that from say 2010 to 2019, the baseline rent growth number was something like 3% a year, give or take. Then it spiked up during COVID to about 18% nationwide average. And this wasn't suddenly because operators had suddenly found this one magic trick, as they say on the internet, right? It wasn't like that. This was all because of mass money printing, mass inflation. This had nothing to do with an operator's ability, or by the way, the tenant's ability to pay you rent. They were literally free money was being handed out. It sounds fanciful. It sounds like it's not real, but literally that was happening. For a
Omar,
little while.
18% sounds so great. Why can't that be the new norm? Come on.
Well, it is great, but eventually, look, trees don't grow to the sky forever. Most of the syndicators that raised capital, say circa 2020 to 2022, they wrote in some version or some case, they wrote 18% rent growth in some case, basically.
Right.
As if that was the floor, that was the expectation going forward. And these types of aggressive assumptions, of which this is just one example, these are what has killed deals. It's not just interest rates. Interest rates are a component. It's not just the underlying asset performance, because the underlying asset performance is fine from a purely performance operating KPI view. Think about it this way. The fundamental viability of multifamily as an investment or an industry, that's not in question. we have constant demand. This is not like the office sector, right? Where you're thinking, well, if I invest in this, is anyone going to rent this at any price? Forget about whatever. Is there just a demand there? And the fact is that the fundamentally multifamily is not at fault. Nothing's wrong.
Yeah, yeah. And this is, I think, the piece we want everyone to sit with because the headlines all blame the rate environment. And rates, again, were the trigger for sure, but you can survive a rate shock on a deal that was underwritten honestly. What you can't survive is a rate shock sitting on top of a performa that needed that fanciful 18% rent growth just to pencil. So, Omar, let me ask the question everybody actually wants answered. Forget the spike, forget the panic. What's the realistic forward number?
Well, look, we believe that the rent growth gets back to around 2.53% circa 2028 or 2029. We'll get into some of the reasons coming on. Yardi's forecast says it's 2.3%. So we're not that far off. I mean, maybe let's assume it's somewhere in the middle by circa 2028, 2029. Again, this varies by market. But either way, you have to understand the regime is set. You don't have these 18% increases in rent, as an example. You have a higher for longer interest rate regime. So the only thing that compounds now are operations, or rather, how good are your underlying operations? And everything else is just noise. Everything else is just noise. So what we're now going to show you is a deal that actually got done in this environment. In fact, in the heat of this environment, it's one deal, one number, same playbook we run every time. So, Miles, this is something you're familiar with, Dover Point,
That's
right?
right. That's right. But
Yeah,
I want you to take it away. I want you to piece this all together for everybody.
I've got some stats. I'm going to be referring to these stats here. Basically, around December 2024, I got a call from one of the workout officers, senior managing director at a nationwide lender. They have an asset in East Houston, 100 and I think 68 units, 1982 vintage, if I'm not mistaken. The property's name is Dover Point, as I just mentioned. Now, here's what they had on the asset. This is a pre-foreclosure asset. They have security incidents in the submarket and on the asset, which means, like, instances where the residents didn't feel safe. The unit turns were halted by the previous operators. Uh, I think possibly due to liquidity constraints, and there's a partnership dispute there as well. Bad debt is running at 15.9%. Their economic occupancy is 73%. This is all around basically a disaster. I mean, there's better words. I don't want to say that. This is an all around operating disaster. And you've got to realize none of the security instances, none of the unit turns, the bad debt, none of this has to do with interest rates. Interest rates are compounding these problems, but these problems are structural and underlying because the operation element is not there. So effectively, the lender now owns this problem and they need somebody who can help fix it.
Yeah, so I used to work in ICU and I remember discussing this deal. And this was definitely an ICU deal. Most operators see that sheet and they're already gone, which again makes me ask the obvious, Omar. Why does that call come to us, Boardwalk, and not somebody else?
Well, the obvious thing everyone has to realize is the question on pretty much every workout, especially these days, comes down to who can the lender call in that submarket or market that can actually close today? They have professional management and who's not going to just basically walk away halfway through this process because now the lender has another bigger problem. So that list on pretty much most markets is 3 to 4 sponsors at best. And we're on that list for pretty much all of the markets we're in.
Yeah, and that's crazy. 3 or 4 in a normal market that goes to like 50 bidders and the highest number wins. So here they're narrowed the room before even that phone call rings to again 3 or 4 at most.
Yeah. I mean, look, the thing is, you need to have a track record and you need to have established relationships before these things happen. In our case, we've done 34 deals, 0 foreclosures. We have an established agency track record. I think we've done 8 or 12 of these agency refinances. So that's the gate. Because if you don't have all of these things from before, real estate is kind of an unfair business. It's kind of a chicken or egg sort of thing where you kind of need to have both. Otherwise, you're just not off the gate. It doesn't matter how intelligent you are. If you don't have all of these components, you don't have a great team, you don't have a great track record in those areas, it's just not really going to work out. So lenders, as I told you, they don't just need another bidder. They need certainty of execution and then the quality of management to execute on that execution. And not everybody has both of these things. Some people have one, some people have two. Not many groups have both of these together, especially in this market right now. And this call used to happen, say, once a month or so. Now these calls are happening multiple times a week. A Dover point is just an example. Now we're going to walk you through the specific playbook we used here. It's identical most of the time. So different asset, different submarket, but the playbook is kind of sort of the same.
Right. Yeah. So, Omar, once Boardwalk takes over, what does the next 12 months actually look like? People hear operational turnaround and assume it means raising rents, right? I think we all remember the capex play of most of these deals from 2022, all about raising rents. Walk us through what actually happens on the ground, and does it mean just simply raising rents?
Now, well, I mean, I wish it was that simple. You and I both know it's not because we're in the weeds every day. This, a lot of this is blocking and tackling 101. That's how you have to look at this. So, five things happen in parallel from day one, and these are overarching five things, right? There are also asset specific activities that get done. We're talking about overarching themes on workforce housing. So, we do these things in parallel. Most operators want to do these things sequentially. I don't really believe in that. We do this simultaneously over a 6 to 12 month period because you have to hit the ground running. That's part of like the real calling card with these distressed assets. So number one, in the case of Dover Point, we're addressing on-site security. The reason here is this market and this asset had elevated security instances. And you've got to realize residents, no matter whether they're rich or they're, middle income or lower down, nobody wants to pay rent and live in an unsafe community, right? I mean, that's kind of the social contract you have, right? So we install 24/7 coverage. We, in fact, subsidize housing for police and local law enforcement authorities to live there. They get a great rate, so they're encouraged to move there. And having their police car, having all of this security coverage there really helps. It helps not just stabilize from a security incident point of view, but concurrently, this is a way for us to now address a big concern for the residents. They see it up front, but also now to take residents' concerns into account. So they have to feel like they're part of a community. And without this move, nothing else compounds.
Yeah, that's a good point. I think security before rent could sound counterintuitive for a lot of investors, but trust me when we tell you that that's not the case. You're shooting yourself in the foot when you focus on rent before security. There really needs to be stability, and on that stable foundation, you can begin to build. So, Omar, what are the other items? First is security. What's number two?
Well, first of all, I think your camera is out of focus, or maybe you're just a little blurry now. But anyways, so look, the second item is we restarted unit turns. Now, as I mentioned, these unit turns were halted. Part of the reason is lack of liquidity and partnership disputes. The concern there was basically that I believe these people were not well capitalized. And when interest rates started going up, it just hoovered up all of their cash flow, especially because they're sub institutional managers. So the problem, though, is if you have vacant units, especially in a market with ample demand for this type of housing, you're leaving money on the table all day, every day, twice on Sundays. So we restart the unit turn pipeline, but we have to be strategic in our judicious use of capex because you can't just go and spend money willy nilly in this environment. So we target units that have the highest rent delta, which means that what is the highest return on investment I could get. It doesn't just mean the highest rent. Because, for instance, if I could get $1,200 a month in rent, but I only had to spend $3,600 versus I could get $2,000 a month in rent, but I had to get $20,000, you kind of have to do the ROI math. Not a lot of sense. It sounds elementary, but you're going to be shocked at how many sponsors and especially these marketing heavy syndicators, they don't even do any of these basic analysis. It's kind of surprising actually. Now
we really had to stop and think about what we should improve on in these units and not, correct? Like that really comes down to that.
Yeah, you can't paint with a broad stroke, right? Exactly. You can't just go in and be like, I've got $7,000 a unit and I'm going to put golden toilets and nice shiny pictures. Yeah, it doesn't really work like that. You have to be extremely strategic. And again, you need to have a playbook here, right? So now when we have the security instances and the community feel and residents' concern taken into account, we've restarted unit turns. Now we can start focusing on collections discipline because it takes a couple of months to change the mentality of residents that were not paying but had the money to a paying customer on time. Not just a paying customer who eventually pays you, a paying customer on time. It takes a couple of months, but when they see they are being offered value, but the management is extremely strong, then that thing turns around. So when we took over, I believe the bad debt was something like 15.9%. In 11 months, we brought it down to 5.8%. Now, that might still seem high, but in workforce housing right now, you're pretty much top tier with this type of bad debt in this current environment.
Right. Right.
And then it's what we're really good at. Nickel and dime. You have to add ancillary revenue. This is in the form of, say, bulk internet, parking, package handling, tech fees, all of this sort of stuff. Most sophisticated sponsors like us, we get anywhere from, depending on the type of asset, 10 to 17% basically off gross revenues, just another income alone. But you have to be strategic in the way you implement them, because if you implement all of them too quickly, it doesn't work, but you got to start doing it quickly. So implementing those and layering on these additional sources of revenue. And lastly, it's expense management, right? We go in and renegotiate pretty much all the vendor contracts. We shop our insurance. So we decide, okay, with our portfolio, should we bring it on to our master? Can it stand by itself? Which one is cheaper? We do all of that. We aggressively appeal property taxes. I mean, that's a sport in Texas now, right? And we do that because eventually what you have over, say, a couple of months, 11 months, 12 months, what you have is the same property, better economic fundamentals, but lower operating costs. But again, you got to be very strategic about it. You can't just paint with the broad strokes, right? So that's basically what it is.
Yeah, and I like the term, focus on the blocking and tackling, right? It's it's these things that are glamorous that people want to run to, the shiny things that people want to fix and focus on. But you really have to work on those fundamental items, and they're not always sexy. Again, bringing in the example of football, games are won in the trenches. They're not necessarily won, except if, of course, you have Tom Brady at the helm, right?
Yeah,
But if you don't have Tom Brady at the helm, you better have really good blockers, and on defense, you better tackle your butt off. So, Omar,
exactly.
all these five inside a year, where does that leave? Where did that leave the numbers?
So that look, this is I'm going to read out over here. So when we took over occupancy, 73% at handoff, and we're going to discuss that. That's 90%, or a little around 90%. Phys bad debt is 15.9%. When we hand it off, it's 5.8%. And rents, by the way, have gone up approximately $50 in a market where CoStar and other sponsors are saying their rents are declining. So that's all the uplift that we've added. We basically outperform peer properties on pretty much every operating metric you can think of.
Okay, so that's Dover Point. That's one asset. How much of the pipeline runs the same way or similar?
I mean, at this stage, we've done 11, 12, maybe 13 workout engagements so far, close to 2,000 units across 5 states. And on pretty much every one of these, most of the workforce housing ones, we run the same playbook. To give you an example, I've got a bunch of stats over here. The borough in Fort Worth, it's 208 units. When we took over, it was 16 fire damage units. This was a foreclosure initiated by the lender. Declining occupancy, we bought it up to low 90s stable occupancy. We outperformed competitors by 5 to 10%, depending on the metric. And now 5 to 10% does not sound like a lot, but 5 to 10% is the margin in this line of work. So effectively, if you're doubling your margin, you are 2x better than everybody else. And that says a lot. On Tree Hill, Jacksonville, 78 units, occupancy, I think, was 76%. In 180 days, we put it to 96%. That's where we executed and took it. Avenue
And, for the record, we were intimately involved with this. I was right there in the midst of it. And this really comes down to being highly aggressive, again, in focusing on the basics. There, it was really making sure that unit turns were quick and efficient, and then being very aggressive, honestly, with marketing and rent. So, okay, there's those two. What else?
So we have Avenue 33. This is an asset from a trouble syndicator. The lender has now slated it for sale. So maybe the sale goes through. We're asset managing it for as a third party manager. 284 units, late 1990s vintage asset. Occupancy was 61%. And we took it to 84%. Revenue was up 30% in the time we have it. And NOI is up 70%, 70 in 8 months. Kansas City asset, 156 units. Occupancy was 86%. We took it to 92%, but with paying customer. Because what happened with the 86% occupancy is you have a lot of non-paying customers. So they're physically occupying, but not paying you the rent. It's a big difference. Little Rock, 301 units. We added $16,000 per month in this ancillary revenue alone. So what I'm trying to tell you is all of these things are happening because you have a playbook and we can run that playbook quickly. But in November 2025, Dover Point, we transitioned it to one of our institutional partners. We got paid for the workout arrangement, for the work, all the work we've done, the asset management fees. And now we stay on the call for the next set of workout engagements because we are now providing an accretive solution to the market that frankly, the quality of management, not a lot of people are providing.
Omar, walk me through who pays who, because I'm not sure that part is obvious to those watching or who will watch this. Pardon me.
Well, there's three parties, right? Number one, in this case, the lender clears the loan off their books. They've got to do that, right? Because for the lender, the loan is the investment and they need to get a return on that investment. The institutional partner now has picked up a stabilized asset at below replacement cost. And you have to understand, most institutions, they're not designed to deal with hairy problems, complex problems. They're running big portfolios. They need clean, safe, stable assets, right? So now they're getting a clean, safe, stabilized asset, but they're getting it at a significant discount to replacement cost. And for us, what we're getting is we're getting our fees and we're earning the next call. So it's like a virtuous cycle. We three parties win. And you have to understand the cycle is the workout work we do, it builds from the call list. The call list generates more and more of these engagements. These engagements feed into agency refinances that we or our partners do. These refinances distribute cash to investors. We've run this more than a dozen times in the last, I think, 2.5 years. We expect to do this at least 20 to 30 times more in the coming next 5 years. And we do these deals with our own capital as well. It's not just workout. Institutional partners. We do this with our own capital. Our investors invest in these deals as well. So that's basically how we're looking at this.
Yeah, yeah. And the decision makers who can sell, they're not on LoopNet or on some
No.
other real estate selling marketplace. They're frankly on the phone with us, really.
Yeah. And look, let me show you why this works specifically for the next 5 years, because the macro part is something that I feel a lot of sponsors are they're just not reading this correctly.
Yeah. Yeah. So the question is, why is there, or the question you could have right now is, why is the right window specific? What is the right window specifically? Why now and not 12 months from now? And I think there's three numbers that tell the story. The number one is construction starts. So from the 2022 peak, they dropped 40%. The completions versus starts gap over the trailing 12 months is 220,000 units. And annual deliveries fell from 500,000 units in 24 to roughly 300,000 by 2028. Number two is demand. Mortgage payments exceed comparable rents by more than $1,000 a month in most metros, which is crazy and sad, but also means that people rent because they just frankly cannot buy. And Omar, the closing window, or point number three, can you explain this?
Yeah, I feel look this window is this opportunity in terms of investing and doing all of this work. This is a moment in time. We think something like 24 months, give or take, because by 2030, the supply cliff that we have, the lack of supply rather, this is gone. The basis advantage, the basis is the price, the attractive price at which we've acquired these assets in today's market. This is already priced in, and so we are buying and stabilizing in front of that. And look, another outcome, guys, is look, there's just fewer buildings being built. More people are renting. Housing affordability continues to be an issue. This is not just going to magically solve itself. And you have to understand as investors, I mean, we look as sponsors, we talk about this all the time. Flashy people, especially flashy sponsors, they need flashy outcomes. They can sound good for a couple of years when the market is going up because nobody cares, nobody looks under the hood. But flashy people typically need flashy outcomes, which is just a nice way of saying their ship sinks pretty quickly. The boring people are going to be around and still operating, still distributing. That's what boring money does. It is so unbelievably boring. They're doing the day to day work. But boring is something that compounds over multiple years and decades. It doesn't sound sexy because this is not a, it's not supposed, at least this business is not supposed to be a sexy business.
Yeah.
This is a compounding balance sheet business that grows incrementally over multiple decades. And you can't do flashy things, which is Miles now turning over. I mean, why don't you take them through what this means for an investor sitting on capital right now?
Yeah. Yeah. Before I do, I think you made a great point. I think if everything is flashy in a deal, I honestly think at this point that's a red flag. But anyways, most investors they ask questions about projected returns, market trends, exit cap rates. These are reasonable questions, but we're here to tell you and to inform you that they're really the wrong questions. If in light of this single one question that I'm going to key in on right now, and that is what is the DSCR trend over the last 4 quarters? This is a key question to be asked, which is again the debt service coverage ratio, NOI over debt service, or the income covering the debt payment. That's the DSCR trend. And again, it's not the absolute level, but the trend. Trending up means the asset is stabilizing under the current rate conditions. Flat means the sponsor is at risk, and trending down means the math is breaking in real time. So we would implore you and encourage you to ask for that. If the sponsor cannot produce a 4 quarter DSCR trend on their existing asset, that sadly is the answer. But again, please, on all the deals you're involved with, you should be able to ask what is the DSCR trend over the last 4 quarters.
Yeah, and to add to that, other debt metrics relate, debt share, loan constants, all of that. But the point is, look, guys, Miles is sort of giving you the playbook for the next 5 years. It's not a forecast. This is not a thought piece with, platitudes, vague platitudes that don't really mean anything. He's given you the actual building blocks and how you have to view these transactions now and going forward because we're in a generationally historic buying opportunity right now. The actual mechanics of how deals get done, how money gets made in this environment, because this is a great environment to buy assets. Miles has provided that to you. But three things now have changed the math. Construction starts, like how many new supplies come into the market, they have completely collapsed. Supply is tightening all the way through 2028. This is a lagging indicator of interest rates going up. The agency debt market, though, is still open, but only for stabilized projects bought at reasonable basis. If you bought a stabilized project, but it's at some crazy basis, best of luck, right? But the only differentiator now, the only thing that compounds now is operations and operational quality because the market is just not going to lift up and mask the weaknesses of weak operators anymore. Those days are gone.
Yeah. Yeah. And this is a rhetorical question, but what would you rather? 5 years of compounding or 5 years of catching or avoiding falling knives? I think we all know the answer to that question.
Yeah. And look, next month, we can potentially, we're going to think about this, we can potentially discuss what happens between lenders and sponsors, say, when they're in month 10 or 11 of a 12-month extension. What gets said by either party? What gets hidden? What are the warning signs that maybe you need to look out for? Because look, understandably, you also have to understand, not even the greatest sponsors in the world are going to have some failures. This is not a business where anybody has a perfect batting record. But all you're trying to do is mitigate your losses. Every single investor, from Warren Buffett all the way down to your neighbor, basically, nobody has a perfect track record. But the differences between professionals and just these marketing heavy syndicators is that professionals minimize the amount of times they're wrong or the value of capital that they are wrong on. That's what they have to look. So until then, all I want to tell you is look, just please note this. Flashy people, I'm going to say this again, I sound like a broken record. Flashy people need flashy outcomes. Boring people generate compounding returns. And the next 5 years, and I feel beyond that also, belong to boring people. This is going to be the decade of the operator. The last decade was a decade of just some random Yahoo who could market and could sell you products. But now you don't just have to do sales, which is very important. You actually kind of have to know how to do your work. And not a lot of people know how to do that. So we're putting our own capital into this playbook. It's not really a pitch. I mean, that's what we do. If you want exposure to it, you want to talk to us, Miles and I, you can reach out to us. We'll have our emails there and everything. But Miles, why don't we take some questions?
Yeah. Parting words on my end just would be before we hit questions is if there's anything that comes up on those viewing right now or the replay that you want to hear about, please reach out to us. At the end of the day, what Omar and I want to do is share these experiences that we've had and what we've seen in the marketplace. And if there's something that's not understood or something that you'd like us to go into depth, we would love that. We really feed off these ideas and want to arm our investors or those in the space investing with questions, with the intel needed to really suss out a good deal. And again, look to something that could be compounding and not you're just avoiding the next monthly update because everything's been bad news.
And guys, this is not a pitch. I mean, a lot of times for these types of engagements, we have institutional partners. So it's not like for all of these pitches, even if somebody came, more often than not, we can't even take their money because we already have an institutional partner committed. So it's not like a pitch. The point here is for you to understand that there has to be an element of sophistication. We have to learn from the turbulent times that have happened in the last few years and take those learnings and going forward, manage our risk and then manage our returns accordingly. But why don't we take some questions now?
Yeah, sounds good. All right. Everybody on the call right now, please do chime in and throw some questions if you have any. But the first one here, Omar, is where does this playbook break? What are you worried about moving forward if you're utilizing this playbook?
That's a good question. Look, I think sustained rates close to or above 6% on agency financing for another 24 to 36 months, they compress agency refinance proceeds materially, even though spreads have narrowed up. And that's the honest answer on the macro side because predominantly this market, apart from, the assumption is somebody knows how to operate and they know how to run the business. This is predominantly a debt driven outlook. The debt is driving a lot of the value, a lot of the returns that are going to happen in the market. And for the distressed assets that we were talking about, we've stress tested these portfolios. The basis discount, this is the discount we got from the last price and what is the stabilized value. The basis discount is so much, sometimes 25 to 50%, that absorbs the shock of these rates going up. Now, the math does get tighter, but things don't break. And distributions still come through. Some quarters they're higher, some quarters they're lower, obviously, but the math holds. But the thing that I think worries me more is sponsor discipline, because you can't get 5 years of compounding if you don't maintain your discipline through the sucky times. So that's it, because 5 years might not seem like a long time, but to give you some context, it's only been 4 years since the Fed started raising rates, and it seems like an eternity. So when you're in the thick of things, 5 years can seem like an eternity.
Yeah. Yeah. This is all about reducing downside risk exposure, right? And to your point, not everything is in our control, right? But there are a lot of things in our control. And those are the things you want your sponsor to mitigate and to key in on and to manipulate so that again, we're, just shooting lines down the fairway, right? We just want to hit the ball boringly down the fairway. We don't need to clear the trees right now. We don't need to do that fancy bunker shot. It's just straight. Hit the ball.
Stable, boring returns beat up one day, down the other, and all combinations otherwise.
Yeah. Okay, here's another question. So what separates the sponsors lenders call from the sponsors? What separates the sponsors that lenders call from the sponsors they don't? Why are these sponsors calling?
Yeah. Look, I think there's a couple of reasons. The ones that come off the top of my head is track record. Lenders are not calling, say, for a workout if the sponsor, say, does not have a solid track record, they've got foreclosures on the record, they don't have a professional management team. In our case, we've had 33 deals, zero foreclosures. So that's a gate that you have to sort of climb over to get on the call list. But look, once you're on the call list, a lot of this is relationship management and then actually walking the walk, not just talking the talk. A lot of sponsors and investors treat distressed investing as a blood sport. We don't. The problem is when you treat it like a blood sport, your counterparty knows that you're treating it like a blood sport. So you might get one deal, but they're not going to give you all these other deals. So you kind of have to play the long game here. It's a lot of this relationship management and knowing what you do. But also, I think that other thing, very important part that people don't index enough on is the ability to have an established agency track record. Because you have to understand, for a lender, when they lend to you or me or anyone else, for them it's an asset. For us, it's a debt, but for them it's an asset, and they have a timeline on that investment. So they need to get it off their books. So if a sponsor has an established track record with the agencies, and again, it takes a little while to establish it, right? And then they're not on the A check and all of these other bad boy lists, that's very valuable because lenders now know that, hey, in the off chance this asset doesn't sell, we can refinance, take it off our books, and go to a secondary market financing. And lastly, I feel, or not lastly, but I think the thing that comes off the top of my head is surety of closing. Surety of closing has always been the most valuable currency, but especially in this volatile market, it's the most valuable currency because a workout officer or lender's nightmare is a sponsor who agrees. They go through credit committee, they go through investment committee, and then the sponsor walks away at the last moment, or they quit halfway and now they're back at the same situation but in a worse spot. So, right now, this is not always the case. Right now, these lenders are willing to take a lower price but surety of closing from a known entity. That's why I said real estate is an unfair game versus, say, a higher price from a flyer or an operator or a fly by night type of person. Now, that's not always going to be the case, but the surety of closing already filters out 90% of the people from the market.
Yeah, and I think why reputation matters is multifamily and this, buy and sell exchange game that we play. It's not a big playground. We speak to people oftentimes the same person we spoke to last month, we're speaking to this month. It's not this huge group of people. And I think that's why it matters. Your track record matters. The fact that you've done an agency refi matters because people frankly know, right? At the end of the day, there's just not that many people in this game. So reputation is important.
Yeah, 100%. Any more?
There is one more. How does an accredited investor actually verify operational depth in a sponsor beyond what the pitch deck says?
Oh, that's a good question. I like it. Let me think about that. Again, off the top of my head, I think first of all, sponsors need to do, or rather, investors need to do, is request the latest rent rolls, the T12s, on existing assets, as an example. Right, not new performers or performers on new ones. Anyone can build a. My dog can build a performer, right? But you got to see what are the current trends right now. Is that T12? Is it a clean T12? What's going on? You look at the balance sheet, the cash flows, all of that. Then, just from a more sophisticated point of view, you can hone in on this. What we talked about, the ancillary income point of view. Like sophisticated operators know this is the one area that they can really drive value in today's market. So they know this number, or at least they know the range of outcomes for this number for their assets off the top of their head. For us, it's anywhere between this 10 to 17% mark, depending on the profile, vintage, and location of the asset. But again, if you're one of these marketing heavy syndicators, you go to one of these guru coaching boot camps, sort of whatever things. I'm sorry to tell you, I mean, these people don't know what they're doing. They have no idea what's going on. And while times are tough for everyone, it's that old John Wayne saying that life is tough, but it's tougher if you're stupid, sort of deal, right? I mean, that's it. And third, I would look at stuff like collections versus bill rate. So think about, you've done all this good work. We talked about, like, say, on Dover Point, all this good work has happened. Well, how much of your revenue are you actually collecting? How much is not being collected? Again, sophisticated sponsors with good infrastructures can give you a good range on that. And unsophisticated sponsors might give you a number. When you actually dig through the numbers, you realize they're wildly off on these numbers, what they think they're collecting versus what's actually happening. So, look, if a sponsor passes all of these asks, I would I would think they're reasonably operationally sophisticated. Again, keep doing more research, but this is just something that off the top of my head.
You know what just came to my mind, and maybe this is something we do on a future webinar, is we keep coming back to how important and integral the debt structure is and evaluating the debt structure even as an investor. These are very reasonable questions. What is the debt structure? How long is the IO? What's the maturity? What's the runway looking like? What's your rate? What was the spread? All these things. Maybe we break this down because, again, that's a big piece to evaluating what's going to happen. You can have everything can look sound from an operational standpoint, but if the debt is broken, the debt's broken.
Yeah, man, look, that's what got a lot of people with their pants down.
Yeah. Yeah. So maybe we go into the details of how to evaluate a debt structure. Again, this isn't rocket science whatsoever, but it might be good to again re-engage with that. Anyways, I think that's all the questions we have. Omar, any parting words?
No, it's going to sound like a broken record. Guys, pick boring people, compound returns with boring people. And if you want excitement, get a dog.
Thanks for joining, everybody. Have a great evening. Bye.